So, Mark, what do you think are the most important issues from your point of view?
Yeah, with background in financial engineering, of course, the issue I'm interested most in is how to model CVA and the other figures we are now interested in calculating and hedging. Starting fairly simple, I think the main approach for calculating CVA is just starting with a simple formula. You have just a product of four different figures, which is LGD, the loss given default. You have the exposure, the expected positive exposure at a certain time in the future, and you have the default probability somehow, and of course then you have the calculate the fair value by discounting the whole product. But of course, which looks very simple when you calculate each part for its own, becomes very complex when you take into account all the dependencies. First of all, the exposure is usually also depending on the interest rate levels, so the discount factor cannot be just extracted from this, you cannot separate it. When it comes to counterparty default risk, and you have, for example, wrong risk components and there are right risk components, which actually means that your exposure has an impact on the default probability, which is certainly the case, which in many situations, which just means that when you have an extreme market situation, for example, stressed markets with share prices falling, interest rates going high, the probability of counterparties to default will increase, and when your exposure to these counterparties will also increase in these situations because you are hedging against these adverse market scenarios, then of course you have a wrong way risk. You will you cannot separate the default probability really from the exposure measurement. And in addition to this, you have the difficulty that considering netting agreements into account, you cannot really calculate CVA only on a portfolio on a single deal basis, which is well in many cases very a simple method. You can very often even use analytical methods if you have just a single trade, but when you have to consider a whole portfolio, you're usually stuck with a kind of Monte Carlo simulation. But still, it's not all. We had this. Well, we have already talked about the evolution of the different quantities we calculate now. The DVA is another aspect. The other counterparty, or your counterparty, will also calculate the CVA of your own, so you have to take this into account when you want to calculate fair prices of the deal. For example, for new trades, that is of course an issue. The other party will take DVA into account. But still, there's this unsolved problem how you deal really with the DVA your own. It's just CVA seen from the other party's side. Therefore, from a modeling issue, it doesn't seem to be too complicated, especially if you do not take into account a double default, that is your counterparty defaults and you defaults at the same time. This is hopefully a rare exception. But still, when you have to these DVA figures cannot be really hedged. So approaching the modeling with a risk-neutral approach is probably not correct. So there's one point of if it really is it right to assume a modeling approach that is basically assuming that you can hedge all the risk figures. The other thing is what do you really want to make with this DVA? There's a lot of implication, or could have a big implication on accounting figures, depending on the accounting rules, especially in Germany, where you have still many banks who have switched to IFRS, but others are still stuck to the German law and have to report the figures to HGB. They differ in the way how you can incorporate DVA. So what you mainly have to do is to calculate both figures. So yeah, and to have to calculate CVA and DVA separately because you need it in your accounting figures. And in both ways. And I think there's still not really clear what this DVA really means. If it's, I think there's still an ongoing discussion if the DVA is more kind of a cost factor or it's more like really something which is should be calculated on a fair value basis on ongoing trade. Personally, I tend to the assumption that it's just a cost. It's this kind of initial cost which applies when you enter a new deal, which you have to pay because you have not you have a kind of a default risk you own. Therefore, you have to pay more for a deal and compared to a counterparty which has less default risk. But this is not something which can be accepted by common accounting standards. So this is one modeling issue. But well, I think it's when you know how to calculate a CVA, it's clear how to calculate your DVA. And another aspect is this already mentioned funding value adjustment. Nowadays also separated into a funding cost adjustment and a funding borrowing adjustment. So you have really two figures to calculate, which really represents the fact that for borrowing you will get other interest rates on your money that you have lent than when you have lent to money by your own for your own use by selling bonds or going to the central counterparty to a central bank, whatever, wherever, or another bank, for example. And also this funding value adjustment, which makes the calculation complete, very, very complex, is then when you want to calculate it correctly, you have also to take into account what is the real funding you need, in taking into account the collateralization. You may also have when you have a partly collateralized portfolio, for example. And also an increasingly important issue is the currency of the collateralization, because posting or the possibility of posting collateral in different currencies because of not only well, for example, when you hedge these against these currency exposures, you have to hedge yourself by means of cross-currency basis swaps, for example, where you have to pay for a cross-currency basis, which also has an impact on your funding costs and will change the spread you have to pay for funding and on top of the so-called risk-free interest rate, which is usually seen, or the most liquid risk-free interest rate, which is seen in the market is now kind of an OIS funding curve, OIS curve, which is still not completely risk-free, but it's probably the best common approximation. I think there's also discussion about which really is the risk-free rate you have applied in the market, because you have also the repo market, which is collateralized interest rates, but I think there's no really there are other issues involved. It depends on the liquidity of the when you have calculate repo agreements, you have to pay interest rates, which depend really on the underlying. It depends on the liquidity and maybe also the potential price developments of this underlying. So it's it makes things more complex. We want to use repo rates instead of OIS rates. Therefore, this is probably the best and a common approach. But I think there are also the although the picture has become a bit more clear in the last few years, so everybody is aware of these problems of OIS discounting, of CVA, DVA, funding value adjustments, and so on. I think there are still a few issues which are where there is no total agreement about how to deal with these issues. And another is also how to calibrate your models. It's one way to one thing to agree what have to be modeled and what are the risk figures. what are the driving factors, but should I model my portfolio simulation for calculating my CVA according to risk-neutral figures? There is implied credit default probabilities from CDS spreads. Should I take ratings into account or bond spreads? What is there the right approach? I think the answer would be in any cases that you really have to analyze before you even start to calculate or to write down your model, what is the purpose? I think before 5 years ago, at least for many situations, there was the one model fits all approach that you have, well, your model must only be good enough and you can use it for many different purposes. This is nowadays, it's not true. You have to really see what you want to do with the figures you have to calculate. And then you have to analyze what are the most important risk figures, which are the driving factors for the PVs you want to calculate. And then you have to choose the model, and it might be a different, the choice might be a different model for different purposes. So it's, I think the biggest issue there really is that you have not this one model fits all approach anymore, but you have to decide for every purpose on maybe a different modeling different requirements on the model, and you have different models for different purposes. Okay, so maybe
it's a lot of issues.
Yeah, of course. I think it's more or less only an overview, because I think most of the people who are here in the audience have already heard of the problem and are not really new to it. So I just wanted to give a brief overview of all the modeling issues I see there.
Okay, thank you very much. Birgitta, can you comment a little bit?
Okay, first I need to clarify. My boss sits here, so I have to clarify. I'm not in charge of everything related to CVA in Commerzbank. I had two groups within the CVA group in corporates and markets. And some of the points that were mentioned are like what is to determine the right approach is CVA, the way CVA I see as being in a very central point within an organization. CVA touches on everything. So there needs to be a clear understanding in senior management and with all parties involved what the purpose of CVA, and I'll talk about RWA, balance sheet, and all of these other issues, as well is, so what the purpose of the CVA, the reserve that a bank builds, is in relation to price adjustments, in relation to prices being passed on to clients and all of this. So once you've decided on what the purpose of the CVA in your organization is, you can then find a model. Once you found a model, it's then the question, do you really have all the parameters in the place you need them to be in order to calculate the CVA? And the parameters, I mean, the advantage in when you look at a trading portfolio, all the data is there. All relevant trade data must be in the front of a system. But that doesn't necessarily mean that the data is also in the risk management or finance system that actually calculates the CVA. So risk management finance do have a different understanding of accuracy, sorry, I can't pronounce the word, accuracy in when it comes to trade details. What might be important, or what is important for a trader, what he needs to know, isn't really important for risk management when they look at the big picture. So there's a different understanding of data quality, or different requirement on data quality once you agreed on a model. And I'm sure, I think you're going to say a lot about data quality is one of the biggest issues, and connectivity. One system being able to pass on the relevant information to another system. You talked about netting. There are so many different netting flags involved in terms of internal netting when it comes to RWA or balance sheet. These are then different netting flags. What is the CVA system really using? What's the data available? So once a problem is recognized, it doesn't necessarily mean that it is actually solved or that an organization knows how to solve a problem. ORS discounting is has been in the market for a long time, but there are still a lot of organizations that can't physically value their portfolios on ORS discounting. When you've got the choice of optionality or different eligible collateral in an agreement, how do you actually, which discount curve do you actually use? And so there's a whole universe out in methodology. There is no standard in methodology. There are standard models and an agreement, I guess, of academia, which models they follow, but the application actually leads to quite a variety of implementations in the market. And there might, I think the German market is, as you say, driven by an HGB result, probably has a different driving factor on solving certain problems than the US or other Anglo-Saxon names do have. And another peculiarity in the German market is the bank levy, something that applies in other jurisdictions, I think France, for example, as well, but it is nothing that a US counterpart would be involved in. So how do you model, or what is the connection between modeling expected liability for bank levy and the FVA, or the liability profile, or the funding profile that you use for FVA or DVA? So there are lots of questions. There are some broad answers that say, well, or there are good answers and bad answers, but there's no standard. And there might be reasons for different choices, and there's not a right choice in principle.
Thank you very much, Birgit. Yeah, so the list of scary issues even grows, right? So, and I can even throw liquidity here, right? People talk about LVA, but we'll leave it out, right? Okay, so now, Dirk, maybe you can tell us about your two favorite topics. And
yeah, probably this is slightly different from what Mark and Brigitta see. Mark coming from the consultant side and then seeing probably various CVA models implemented at various banks. Commerzbank apparently running CVA desks successfully for quite some years now. I work at Decker Bank. Decker Bank is sort of different from a usual bank because it's asset management with a bit of banking attached to it. So we never thought that CVA was really a big issue for us. Until a certain point when you can no longer ignore the market and you have to say, okay, we have to do something. And then you actually go through the process, which Brigitta shortly mentioned, and you have a lot of questions. So what I will tell you in the next 10 minutes or so is probably more questions than answers. We're currently in the process of actually implementing it front to back. And I just want to point out actually what are the points which we were going through. Part of it already answered, part of it needs to be answered. From the list which Jonas sent around this afternoon, so there's a mixture of consultants and banks, at least on the invitation list. I guess people coming from banks might sort of see similar experiences which they had, and hopefully the consultants will a little bit understand what the banks are looking for. So let's start. As Dimitri already pointed out, the topic of CVA, DVA, LVA, FVA, and we have various others probably which you continue on this list, sort of were there pre-crisis as well. I remember from in the early 2000s at Westerby we calculated something called lesser counterparty reserve, which was only for counterparts rated below BBB. And then starting with 2005, 2006, the literature on the topic of CVA, counterparty risk adjustment, sort of exploded. And then probably with the setup of the crisis in 2007, 2008, the issue of CVA was really there and you could no longer ignore it. Closely followed up by the DVA topic, and then probably in the last month more actively discussed the topic of DVA. So I think with all the taking up all these issues into Basel III and in IFRS, HGB, etc. You can't no longer pretend, well, this is something which is happening in the market, it's just the big players. Nothing really worth looking for for a regional bank like a bank is, but it's really concerning everyone. And it doesn't really matter if you're under a CSA or not, you have to take care of the risk and understand it. So once you realized that you can't put the topic aside, you have to think what you're actually going to implement. And depending on your business, that can be anything from small spreadsheet solution run by some trader who's actually doing the trades and probably a risk controller who's validating and verifying the stuff, passing the data on to the finance department and regulatory reporting, etc., up to a full-fledged project which really covers the bank front to back, from the trading areas via collateral management, the back office guys, risk, finance, and last not least in this case, the IT department, of course. The first thing which you should answer if you're trying to establish what kind of project do we actually need is to figure out what you actually, as Brigitte said, what do you actually want to do with these figures? It's not just about calculating them, it's really using the figures. So you just want to be able to price the CVA correctly, figure out if your counterparts are screwing you? Do you want to actively hedge your CVA risk? Do you want to steer your risk-weighted assets? Probably you want to steer your clients and then just make the most of it and then just saying, okay, I have a model and the price is right. So there's quite a big range of potential applications and uses of CVA. When I talk about CVA, I just include all the other ones as well. Yeah. Once you have made up your mind what you want to do with the CVA, the next step is probably you have to talk about infrastructure. If you look at typical market risk calculations and compare that to calculations which you need for a fully fledged CVA or similar counterparty risk calculation, then there's usually, I would say, two orders of magnitude between the two calculations. If you take a simple example, you have, say, 5,000 Monte Carlo scenarios which you want to run per time horizon. You have 100 time horizons. And just say for your counterparty or CVA model, you use a reduced set of risk factors, just 2,000 risk factors instead of the 8,000 or 10,000 which you're using in your market risk calculation. That gives you at least 500,000 market scenarios under which you have to revalue your portfolio, compared to probably 10,000 scenarios which you use in your valued risk calculation. Together with the 2,000 risk factors, that adds up to just about 1 billion market data items which you need to store in your system. So we're talking about really gigabytes of data which you need to actually perform the calculation, which is not only, even nowadays where gigabytes are not that expensive anymore, but it's still a lot of data to handle, and you need to handle it fast, especially if you want to do pre-trade analysis and things like that. Another decision which you have to make is buy or build. You can either say, well, this is a highly complicated topic, I already have lots of systems and I need somehow to mingle in between my new engine. Probably I want to reuse part of my valued risk engine. It's a similar setup, you have database, calculation engine, and reporting side. Or you just go out in the market and buy Quantifi. There's other vendors as well, but let's just take this as an example.
Can we close the panel now?
Yeah. I thought it was only fair to mention that. So that's one thing which you have to decide as well. That probably, of course, depends on the capabilities of your bank. Yeah? If you have a big IT department, well-educated, everyone knows what to do, then it's fine. If your IT department is more the sort of integrator, then it's probably better buy something. That's the sort of thing which you need before you actually start the project. Once you figured out what you want to do, so say you want to buy a system, then still there's a lot of integration tasks which you have to perform, linking all the systems. But at that point, you need to figure out what model do you actually need. If you're going for a third-party software, then you will probably do some beauty contest, figuring out what is the right software for you. There's more than Quantifi out there in the market. I think that's no secret. After figuring out what are the relevant portfolios, usually probably you start with a fixed income business, which is, I guess, at most banks deemed the most relevant portfolio for CVA. Then you need to look in other portfolios as well, the equity derivatives, if there's enough long-range exotic equity business probably, credit derivatives potentially, commodities mentioned yesterday, another topic. We don't trade commodities, so I can't comment on this one. That's the starting point for the modeling. What are the products which I want to model? Then you need to think about what kind of model should the model look like. Do I need an integrated model? Do I want to generate scenarios combined for all risk factors at the same time, use all the correlation, probably even impose some copula to link all the risk factors together? Or do I stick with a simpler model, which probably has not the nice mathematical modeling of having a real joint distribution, but just sort of loose mixture of distributions, but which is probably more tractable and more easily to understand what's actually going on. Then, of course, the calibration issue, which we already mentioned in previously. For CVA, you are calibrating against current market data, so market implied or risk neutral scenarios. But you will have to face the fact that not all the market data which you need will be there. And part of the market data which is there is probably not in the required data quality. So if you have market data with huge bid-offer spreads, especially for longer dated products, remember you have to generate market data scenarios for time horizons up to 20, 30 years. And so each error which you have on your input data is just augmented once you project to the far end of your time horizons. So you really have to carefully pick your market data, what to use, and even consider, well, for part of the data, there is no market data, market implied data, which I could use. Correlations being probably the most famous example on this. Certain correlations you can probably extract from traded products, but a lot of correlations we have just to back out from historical time series. And then, of course, the next problem, how long do I take the time series? If I want to forecast correlations over a time horizon of 30 years, is a 3-year time series or 5-year time series long enough? You can't use, if you use non-overlapping periods, then it's definitely not enough. So you have to probably use overlapping time slices and then adjust for autocorrelations, which is a lot of fun, but quite a lot of work as well. So there's a lot of questions which you need to figure out on the market data side as well. Then, of course, the PDs and LGDs, crucial point in CVA and counterparty calculation as well. Ideally, of course, the PDs should be market implied, so we'll take CDS. If you want to go hedge your exposure, then CDSs are the natural instrument. So that would sort of suggest that the implied probabilities, default probabilities from CDS is the right probability to actually use in your CVA calculation. But well, it's a different market segment, yeah. So a swap with counterparty exposure is something different than the CDS. You have different market liquidity. You have different drivers in the market. If you look at CDS spreads, they're driven by a lot of non-economical reasons currently. And so the question is if CDS spreads are always the best approximation for your risk-neutral default probabilities. If you figure out that they're not, and for some corporates, counterparts which you have, you probably even don't find CDS spreads, then you have to sort of step back and see, well, I could use some mapping approach, say index mapping or map to a similar counterpart, or I have to fall back really to historical PDs and sort of adjust them for market changes which I see in the CDS market. So that's at least our choice of varieties which we discussed on PDs. For LGDs recoveries, it's probably slightly simpler because I guess most of the banks would use just the market implied, and when I say market implied, it's the market with the I instead of the E, because apparently the guys at market are the ones who would provide probably all the banks in the world with CDS and recovery data. Stochastic recovery rates, of course, is very interesting and challenging from a theoretical perspective, but difficult to implement. And so another model which you need to calibrate to data which is almost not there. So from an academic point of view, definitely highly interesting, but not sure if you really want to use it in a day-to-day business. When you talk about correlated scenarios, then you have to answer the next question: what do I do about wrong-way risks? So the risk that my exposure increases at the same time when my counterparty, the default probability grows. And of course, you can do a fully integrated model where you do a joint scenario generation for your risk factors driving your exposure, plus the risk factors driving your default probabilities, and if you do a simulation, your recoveries as well. Can again apply some copula and come up with a fancy scenario generator, well, I think that's what most of the banks do is apply scenarios, which is a bit more intuitive and gives a bit more flexibility for steering the portfolio. Modeling is always nice, but if the model forces you to react in a certain way, and especially when you comment your figures to senior management, the model says this is the figure, and someone just reacts on it. That's not always a good idea. So if you have some more flexibility with scenarios, it's probably from our point of view the better approach than trying to model everything. On the wrong-way risk, probably one comment here. Talked so far mainly about OTC derivatives, security finance transaction, repo, sec lending, etc. Well, I'm not sure, but from a recent survey which I saw, most of the banks wouldn't cover that in the CVA charge. But the topic of wrong-way risk is especially important there as well, because you have these huge collateral pools, hundreds, thousands of different securities in there, and they definitely correlated in a lot of cases with your counterparty default. So if you talk about wrong-way risk, then you should take into consideration your repo and sec lending business, definitely. Once you're on the point of talking about, well, what do I model, which positions do I take into account, you can, of course, sort of help your IT department and increase the performance by some business decision in just keeping out some of the, but just keeping out some of the positions and products from your CVA calculation. So you could pretend that, say, sovereigns, government agencies don't present any credit risk to you, and you keep them out. For DECA, we would argue that, well, the savings banks and DECA, we're on the same sort of guarantee construction, and so there's no real counterparty risk on trades between DECA Bank and savings banks. You have probably own funds, which you treat differently than some corporates. Then, of course, you have a lot of trades on a CSA, where you could pretend, well, the remaining credit risk on these trades is so small, I just forget about them. Not the best solution, but one solution. So that will help in the end to sort of reduce the number of trades, the number of time horizons which you actually have to calculate, and therefore probably save you a few hundred CPUs which you otherwise need to buy. Another topic which Birgitta already mentioned is the one of CSA, collateral management. One of the important ingredients of your CVA calculation, as well as for the counterparty risk, is the definition of your netting set. Which trades actually form my netting set when I aggregate the exposure vectors. And these netting sets can be, first of all, you have to make sure that they're in some machine-readable form. That should be the case in most banks, and not just in the CSA, somewhere documented and printed out in some folder. And they have to, of course, be in a way readable that you can ideally just put in a number of trades and you get the netting flags back. That should be the usual setup. But the netting set itself is not, there's not just one definition for a netting set. Depending on which figure you calculate, for what purpose you calculate the figure, if it's for economic purposes, if it's for regulatory purposes, for risk, or for say, equity capital calculations, you might have different definitions of your netting set, which you need to store somewhere in the system, and of course then take into account.
I'm sorry, Dirk, 2 more minutes.
Yeah, that's fine.
Thanks.
The next business, the next part is the process and steering part, which usually, well, you talk a lot about modeling, but most projects, at least the bigger ones, which I saw, are probably just about 20% modeling, 40% processes, and 40% data. So with all your CVA calculations which you're setting up, the IT infrastructure, what you shouldn't forget, what Birgitta told us as well, is the process. What do you do with the figures? Who is actually steering the figures? Who is responsible for the methodology? Who is responsible for the daily run? Which figures do I report? What do I expect? What happens with the figures? That's all things which you need to address during your implementation phase, so that once you implemented everything and tested it and up and running, you can actually start using the figures, reporting them, and acting on the figures. You have to figure out if you want to do intraday or just end of day, if you want to have the ability to do an ex-ante calculation, or if you're fine with just ex-post figuring out, oh, that was a bad trade. You want ex-ante calculations just for big ones or for all trades. You have probably traders which are so clever, say, well, for standard types, I just know by heart what the correct figure is, so you don't need it. Then, of course, question, do you have a central CVA desk? Do you have decentral CVA desks? So that's a lot of things which you need to, in parallel to the implementation, take into consideration. The topic which I probably then would skip is the one of CVA VAR. It's not the only thing which you have to do is calculate the CVA actually as a pricing adjustment, but Basel III forces you to calculate a valued risk on this price contribution as well, which seems to be plausible. And there's, of course, some further complications in there, which model to use if you have already a specific risk model for your market risk in place. You might just reuse the model, but there again, you have different setups. For the regulatory CVA charge, you only generate scenarios using the default probabilities and recoveries. You don't change the market risk factors on your exposure. Whereas, of course, for an internal steering for your economic calculation, you want to have, again, combined scenarios which modify default probabilities and market risk factors. So essentially use all risk factors. That's sort of the next step.
Okay, thanks.
And that sort of brings me to the end.
Okay, thanks, Dirk. It's very informative, yeah, definitely. And Mark, can you maybe comment as a person who is advising?
Yeah, maybe I would add one step just at the beginning. If you have seen or analyzed what kind of risk we have, I think you have to first think, well, can you avoid the risk at all, so you don't have to hedge it and don't have to calculate CVA for these figures. I think there are many. Well, many approaches. The most important one are certainly collateralization, which is now very common between banks. I think there is now no bank in the German market which can avoid collateralizing their deals with other banks. And the other thing is, of course, what regulators are doing is pushing the counterparties to pushing the banks to work more with central counterparties. Both measures are certainly decreasing the exposure to counterparty credit risk, but still, of course, there's a remaining risk. I think this is something which one also should take into account. I just know from our clients that which have experienced a default of the counterparties, which they had deals with which has been collateralized. It still turned out to be a big problem to finally agree on what really was the exposure at the time of the default, if it has been over-collateralized or under-collateralized, if they have to post some collateralization again, or what really was the position, especially in terms of market turbulences, where we have big market moves. It's when you look later at that time point and try to estimate what all the derivatives, where we have only theoretical values for, have been worth at that time point. It could be really a challenge, and then could force you into into lawsuits for many years until you come to a decision. Especially with some risk, there's also that what we see now that the models used now for derivatives pricing 5 years after the financial crisis started are different from what we used at the point when it's all started to begin. So it's also a question: what is the real price of the derivative? What is the real price of a derivative as of, say, 2007 or just after the Lehman crisis, after September 2008? What is the right model to calculate the theoretical value of a derivative that you had there and which was collateralized? So there's still other issues and risks you have to take into account, even if there's a collateralized. And another issue, when you have taken your collateralization and risk mitigation process into account, is that maybe suddenly you have to focus a deal with risks that are haven't been in the focus because it's a minor issue when you look just at the trading volume. I guess most banks have the biggest exposure in interest rate derivatives, but since this is mostly an interbank business, or at least to a large extent, which is not true, for example, for commodity derivatives, where we have often counterparties from corporate sides where you don't have the possibility to have collateral agreements with them because they just do not have the cash and won't turn out. So I think there's also the problem that sometimes when you try to calculate CVA, you see that you have to deal with more exotic asset classes than you are used to deal with and you have maybe neglected for other issues. Another point I would comment on was you have mentioned the recovery rates, which is of course it's an important source of uncertainty. What we've seen in the last crisis was recovery rates between near zero and near 100%. So there's really a big difference from what was common practice before the financial crisis, just to estimate that recovery rate is 40% and that's it. But I'm not optimistic as you that you can really estimate the recovery from implied market data. I think there's no CDS. There are only very few products, and they are not really liquid, which has a significant exposure to the recovery rate, which is implied there. For example, when you have a CDS, the premium doesn't give you any hint about the recovery rate. It's just you can assume a recovery rate of 10% or 20% or 40%. What only changes is the implied default probability will be different, and you get the same premium. and therefore it's not really easy to imply recovery rates from the market. I'm not sure how you will do it.
No, I was talking about the market implied recovery rates. So the consensus recovery rates supplied by market.
Yeah, but market sometimes posts for the same counterparty credit spreads with different recovery rates. So it's.
I'm happy we finally have something to disagreement or something, but I probably will have to go to Brigitte and ask about her favorite issues, right? So we can continue discussions after this. And thank you, Mark, for your comments. It's really interesting. So, Brigitte, what do you think are the two most important?
Well, what we've, I present the practitioners or front office now. Point of view. We've, we started, or in the organization, we started with now counterparty portfolio management some years ago, and we did the CVA pricing, CVA hedging, and went through quite a lot of phases. And what we've seen in the last couple of years, or let's say 1.5 years to 2 years, is that, there's a paradigm change in the market. And in a couple of years ago, trading and sales just said we made that much PV, so we should be paid on this. Some operational costs were deducted from this, and that's not valid any longer. So the bottom line of every trading organization is now determined by, yes, it matters what trading and sales achieve, but it also matters a lot what risk and finance actually debit to the trading desk in terms of cost of capital, what are the funding costs to fund either collateral or the trading trading balance, and all the other kind of indirect costs that now apply to kind of the limited resources that in the past weren't really limited. Capital was plenty, funding wasn't an issue, but all of these points are now an issue. And what organizations have to deal with is a huge legacy portfolio where these trades or where these costs weren't really appropriately priced. Nowadays, for every new trade, we try to consider either by putting it into the client's trade or by at least being aware of what the implications each trade has on the capital structure, the CVA structure, so the reserves that need to be set aside for counterparty credit risk, the capital that needs to be set aside for the unexpected losses, and also the funding requirements, both on a collateralized and an uncollateralized basis. The reason why I think that a CVA desk is actually central to this kind of considerations is that all of the other kind of exposure-driven costs are very much related to what drives CVA, and CVA seems to be the most examined part of a risk managed or a balance sheet cost in terms of being examined by the front office and being traded. So all the risk parameters that influence CVA, no matter if you consider DVA or not, are actually also drive the capital. So capital is driven by market parameter changes as CVA are influenced by it. Capital is influenced by, so RWA is influenced by the PDs, is driven by LGD. It is driven by the same influence parameter. So if CVA go up because trades go into the money and the exposure increases, you can expect the RWA go up as well. There are differences in the calculation of exposure for the reserves, for CVAs, and for capital purposes. And these differences imply as well how you hedge these exposures and if you can hedge them at all. The major difference is, one big difference is CVA are priced up front. So your organization can think, or an organization can think about if they want to pass on the CVA cost, which take account of the entire maturity of the trade, if these costs should be passed on to a client. Whereas in terms of capital, capital is just charged and calculated on a kind of accrued basis. Capital always has a 1-year horizon. And after trade inception, once a trade is done, it is very difficult to renegotiate a trade's details in order to generate more money. So you've got this trade on your books, and you need to, and especially with interest rate derivatives, they do go up to 20, 30, 40 years. You need to find a way or think about how you deal with the cost that you don't know yet and that you're not yet debited with in 5, 10 and more years. So there's a huge exposure, there's a huge risk, potential exposure that isn't yet considered anywhere in the bank. I think the maximum maturity in credit RWA profiles is 5 years. So there is, and what we saw is that particularly these long-dated swaps with the interest rate movements we've seen in the last few years, when rates were coming down, I mean, traditionally you expect to receive the fixed rate from your client, from your corporate client, and you hedge this in the market with a market participant. So you tend to have a positive mark-to-market exposure with your client. So you received a couple of years ago, rates came down, trades have a huge mark-to-market, and you tend to have a kind of negative mark-to-market exposure with, or mark-to-market portfolio with your hedge counterparts, where you post collateral. So this trade done a couple of years ago, where you generated some profit, still occurs cost in terms of, well, CVA changes. Let's assume they are hedged. But in terms of capital requirements on the client portfolio, clients are usually not members of clearing houses. If it is a corporate client, it's very unlikely that they go into the customer clearing. So this capital will remain. The capital cost will change. Trading is debited, or the bank calculates RWA and cost of capital on an accrued basis. On the other side, you've got the mark-to-market, let's say the negative mark-to-market on the trading portfolio, on the hedge trade, where you need to fund, let's assume it's collateralized, where you need to fund the collateral. Based on a bilateral collateral agreement. The trade, if it was a standard trade, might already be passed on to a clearing house. Then the funding implications might be different, because there are differences between bilateral collateral agreements and the collateral agreement, or the collateralization of clearers, or for trades with clearers. When a trade is cleared in Germany, the bank levy doesn't really matter. There's a certain element of the bank levy that taxes the liability on the trading side. Liability is the negative mark-to-market. You don't have netting with collateral, so you see the kind of naked negative mark-to-market of every transaction. If a trade is passed to a clearer, then mark-to-market doesn't matter, just the notional component. So in a way, by putting trades or passing on trades to a central clearer, you can get rid of certain costs, like CVA should go down, RWA will be small. Well, RWA, currently there are no RWA with positions to a clearer. This will change under Basel III. And there's no bank levy. If the trade can't be cleared for whichever reason, you will have all the other costs, RWA and bank levy, in addition to the funding costs. And what we've seen is that for new business, we try to calculate the marginal impact a trade will have on each of these components, the kind of expected exposure profile for the reserve, the regulatory exposure profile, making certain assumptions what might happen or will happen, well, what might happen after the 1 year horizon, so that we'll have an idea of where we think the exposure, the regulatory exposure will be in over the life of the trade, and we'll make similar assumptions for how we expect the mark-to-market of the trade to perform in order to calculate or have an idea on the bank levy. I think the changes in the market have also led to changes in risk perception. By the regulator thought or thinks by imposing trades to be now passed on to a central clearer, either directly or via client clearing, that risk is being eliminated. It's surely counterparty credit risk will go down, but another source of risk, liquidity risk, is being created. And this liquidity risk by, there are all kinds of numbers by different consultants out in the market. If all corporates have to clear 17 trillion of good quality collateral need to be provided. And the credit or the requirements on collateral quality by clearers are quite strict. They have to be cash. There's a certain element that can be posted in high quality government bonds. But if everything is going to be cleared, this isn't available. I mean, there isn't that much cash around. Where would banks generate this cash from? So instead of having counterparty risk by entering into cleared position or into bilaterally collateralized positions, you enter into liquidity risk. And so are you sure that your counterpart is able to put up every margin that is required? So by changing the risk, it's not really eliminated from the industry. And what we've seen in collateralized exposures, we've seen in the crisis that, or I think Mark, you mentioned it, that markets become a lot more volatile, and that when you think you were now collateralized, the actual mark-to-market of the trade at closeout doesn't usually match the collateral you hold against that position, because collateral usually has a time delay. There are collateral disputes, and by having more and more trades being collateralized, and by banks having more and more different systems, some using ORS discountings, others don't, you'll have more disputes, and these disputes will lead to larger positions being uncollateralized. So there's all different sorts of problems or challenges related to collateralizing trades. Some of them can be modeled, others can't. Some problems or some issues can only be kind of dealt with by having really stringent operations, by being aware of where collateral disputes are, by being aware of a counterpart not making payments, by seeing patterns in counterparts deferring payments on certain transactions and finding ways around it. The best or one solution we found is to limit the volatility, the directionality of a collateralized portfolio. If the portfolio between margin calls can't fluctuate much or won't fluctuate much, you'll have less of an uncollateralized risk. I think Mark, I'm sorry, it's again you. You said something like one question is, should risk be avoided? And I think that's definitely a question. There are, me coming from a trading point of view, I think there's a price for everything. But the price might be so prohibitive that it doesn't economically make sense to do certain trades. And this is on one side driven by the regulators, by imposing more capital on non-clearable trades, by having larger funding costs or higher funding costs. I think all of this will lead to a standardization in the market, and I think the market will kind of divide or segregate into more standardized trades where margins will go down. Everything will be dealt and also settled electronically, and a few really structured trades where margins will become larger, where some banks, because of the prohibitive capital requirements. Some banks will go out of the really structured markets. So those banks that remain and that continue to offer structured credit derivatives, structured interest rate derivatives, will see that they have higher costs on this, and the clients who buy these products or who need these products for their hedging purposes need to or will see that margins just increase. So I think a lot of standardization and a few remaining structured trades, but the activity on the structured side, I think, will go down. What I'd mentioned earlier in with respect to data quality and also netting flags is CVA, RWA, and be it credit RWA or the CVA capital charge, funding, collateral requirements are all linked and driven by similar factors, but they have differences, and all of these differences need to be understood. We had some cases where sales wants to go into a new jurisdiction, and credit said, we are fine with this, we need a collateral agreement. Collateral agreement can be incorporated, but we found out there is no netting, no external netting applicable or regulatory netting applicable between the CSA and the exposure. So by having a CSA, you actually increase your regulatory exposure by posting collateral, which is an obligation, and by having posting collateral, having exposure to the client, and the exposure of the underlying trade that can't be offset. So something that makes sense from a credit point of view, and also from a funding point of view, because collateral can be used as a funding source. This might make sense, but it needs to be weighted against the higher capital implications on these products.
I'm sorry, 2 more minutes.
So the challenge I see is to bring all of this together and to make everybody involved in that process, be it sales, be it trading, be it treasury, be it risk management, calculating the regulatory exposures, be it finance, calculating the CVA and RWA, by making them all aware of their responsibility and understanding the implications of their actions. Okay.
Thank you very much. Dirk, can you say so?
Yeah, sure. I think what became obvious during the panel session is that even the simple things in life, like a plain vanilla interest rate swap, is nowadays a rather complicated thing. In say the first half of the last decade, everyone was involved in modeling more and more exotic products. We have labor markets models with N factor, stochastic volatility. You have huge stochastic volatility, equity products out there, not forgetting all the credit derivative stuff. And now with the crisis, we're falling back to simple products because, well, the market is no longer interested probably in that much exotic products. But it turns out that these simple products are extremely complicated. And you can, even a simple swap, as Brigitte told us, you can only really, for the bank as a whole, steer in a reasonable manner when you break up these it's usually called risk silos. So in the past, everyone tended to look at his special part and didn't really look what the others were doing. So we had market risk, credit risk, liquidity, and they were all standing besides each other in parallel, but not really connected. And the funny thing is that now CVA, DVA, and funding value adjustment sort of links everything together. And what I found most interesting is that when the crisis really kicked in, everyone was saying, oh, it's all about models. It's these rocket scientists, these quants, which really brought the system down. And now we have these regulations. We have Basel III, and then we have IFRS 9 and 13. And the regulators actually impose on the banks things which are much more complicated than most of the stuff we did before. I mean, CVA is sort of something which came out of the market, but it's now part of Basel III, it's part of IFRS 9 and 13, so you can't really say, well, not interested, not doing it, you have to. And everyone is still talking about that banks are too complicated, doing too complicated models and stuff. And in reality, the regulators are forcing us to exactly do that. It's the same with the rating agencies. Banks shouldn't rely on rating agency, and on the other side, they're actually putting it into the solvency statements that we have to use external ratings. So I think there's a big mismatch between the public view on what banks should do and what the regulators are then trying to impose on us on the backside. I'm not completely agreeing on the exotic trade side. I mean, if you look at really exotic trades, and I'm not talking about Bermudan swaptions, which probably were exotic 10, 15 years ago, the margins on these trades are anyway huge, especially if you trade them as part of a structured note with some retail client. And sort of hiding your CVA charge on the exotic products, which you probably can't calculate up to the last digit, and so you have to make some guess. I don't think that's really too complicated because the margins are anyway huge. So my interpretation that the market for exotic trades is going down is mainly because there's not so many people interested in exotic trades. And especially in Germany with all the certificates, a lot of the highly complex derivatives were actually sold as structured notes into the retail market to clients which, if you are fair, couldn't really, up to the last digit, understand what they were buying. And so I think that's more the reason than the CVA charge on exotic products, which...
I think you're fair on retail clients. I was thinking about institutional and corporate clients.
Yeah.
So I wouldn't know much about retail clients. Right?
Okay. So we agree.
Yeah. Thank you, Dirk. And on behalf of all quants, thank you for shifting blame to regulators. I'm sure each panelist could talk more and more, and I'm really sorry for cutting everyone, but we really have to leave some time for Q&A. So.